Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. While markets continue to digest a bit of a macro data roller coaster, there is an enhanced case perhaps for yield via dividends across today's marketplace. If the combination of modestly higher growth along with a good dose of volatility continues to be a reality for the medium term or longer, might a dividend strategy bring you closer to your goals? Or perhaps you approach the dividend strategy as one to simply bring down your overall risk profile while continuing to lean into a rising equity market. Joining us here today to further discuss these aspects of the strategy is Fidelity Dividend Fund Portfolio Manager Don Newman. Don, great to see you again. How are you?
I'm great. Nice to see you, Pamela.
Is there something new about dividend investing right now, or actually is it sort of refreshingly nice to be in a strategy that's been around for a while?
I think this is just a really good, the last sort of 6 months or so, we've had so much volatility and it's really given investors a reason to sort of revisit and sort of just reaffirm why you do invest in dividends. And I think we were talking about a little bit earlier, there was a point this year, S&P 500 had gone from like a little up to down 20. Which would put a lot of stress on a lot of people, and unfortunately there's a lot of people that may have made I can't take this anymore, the volatility is too much, I'm out, and then we had a 2-hour stretch where the US administration decided to say, hey, actually, we're pulling back on the tariffs, market's up 10%, which is a year's return in about 2 hours. So the volatility has been huge. The nice thing is about the dividend strategy, the volatility hasn't been that big, and especially, Canada this year has actually been sort of a little bit of a bastion of stability. At the worst point of the year, I think the dividend fund was down close to 7%. It's now sort of up between 8 and 9.
Like when markets were down 20?
Yeah, when the markets were down 20. So there wasn't the need to be calling up an investment advisor saying, oh my gosh, I feel like I'm losing on one. Down 6 or 7. People can handle. So it's like the stability, the yield, the companies that are not, going from 40 times earnings down to 25, you're already sitting at 15 times earnings. That's a pretty reasonable number. So less volatility there. My pitch to investors and investment advisors that I always come to is just, the biggest mistakes are made when you get really excited at the top and you get really depressed at the bottom. You buy at the top, you sell at the bottom, you lose a lot of money. The idea is keep invested in a good strategy with maybe a little, and what I try to do with my funds, a little bit less volatility over the time. So I always try, it's like good company, reasonable prices, maintain and grow dividends over time. And because you've got a little bit less volatility, you hold on longer, you get the power of compounding, and you look back in 5 or 10 years and you've done really well with a little less stress.
Yeah, holy smokes. Yeah, because that was really quite something, I think, for a lot of investors to hold on, as you say. That's
and
when
it's
mistakes
hard.
are made. Yeah.
So
when we think about sort of this macro data roller coaster, which it has been, because we're now sort of sitting on the cusp of earnings for the second quarter, and we're wondering what the tariff story is going to mean and where we're going to see it and so on. Have the sectors that you look at, the companies that you're in contact with all the time, have they gone to this sort of we've passed peak tariff concern? What it feels like people leaders of companies are actually speaking a bit more.
Yeah, well, I think the big sort of concern was with the tariffs. One, the big numbers that were going to be put out in tariffs, and hopefully that's been scaled back a little bit at this point. But the other big concern was just like you create uncertainty, and I always like to say, like, the market can deal with good. The market can deal with bad. The market really hates uncertainty. CEOs hate uncertainty. If they don't know what to do, what ends up happening is they say, you go into conversations, what are you doing? Pencils are down right now. We're not sure what we're doing. If pencils are down, that means investment's not going into the system. That means companies aren't investing in productive resources that can help grow their earnings over time. And it's not good for corporate profits. I think what we're seeing, and we're hearing at least from some of the banks when we're talking to them, is things are slow, but conversations are starting again. And there's some green shoots out there where companies are saying, okay, we're a little more comfortable with the operating environment. We still got to see, there's U.S. administration tends to flip-flop a fair bit. But, we've got to start thinking about sort of investing and doing the right things for our stockholders and our company. And we're starting to sort of the idea of like, okay, we've got a little bit of a better feel, things seem to be a little more under control, and we can start talking about actual doing projects and putting CapEx in the ground again.
Okay, well, let's talk about CapEx being put into the ground, because there are a number of discussions about that. I mean, one of them is pipelines. Yep. There seems to be the overall energy corridor in Canada discussion. The whole world is talking about data centers. This is a very global, it seems like, structural change. What does it mean again? I mean, big companies that sink things in the ground to pull things out tend to produce dividends on the whole. Yeah, so I mean, from that standpoint, there's the infrastructure side of things. Right. And we're going to this is going to be something that Canada's going to have to spend more money on, and Carney's talked about this. Canada's going to have to look to be a little more independent, going to have to, develop relationships with other countries. Hopefully we can have a great relationship with the U.S., but think about Asia and Europe and becoming a little more self-sustained. And that's going to mean we're an energy superpower, more money in the ground in energy, more money just developing our own resources here. And I think over a long term, that's going to be great for the Canadian economy. There is, you mentioned sort of data centers and power, and that's something I've been talking about on these webcasts for a long time now. And there's the tech companies where it's very, very sexy and trade at high multiples, but there's also the old economy, boring companies that are going to see sort of a renaissance in demand. Utilities.
Somehow you got to get the data centers powered, and that means utilities. And then we've sort of talked about this. You go and talk to a utility and you ask them, when was the last time you've seen demand this good? And the answer is a little bit in 2000 and then back to the 1960s with the advent of the air conditioner. Because demand is going from sort of flat to, in some cases, it could be up high single digits, and which are numbers that are like almost incomprehensible.
So we're going back to the most recent example you just gave there. We're going back to sort of the energy super cycle with that type of demand.
Yeah, it's the advent of onshoring and just the amount of power that's needed for all these data centers and AI is something that the utilities haven't seen in some cases in 60 years. And it's not like you're going to get earnings growth that historically would be 4 or 5. It's likely going to go to 7. It could go to 7. It could go to 8.
It's not going to go to 25.
It's not going to go to 25. Okay. So it's still sort of boring. But there's a 4% dividend on top of that. There's maybe 7 or 8% growth. But it's the duration of that growth, and that's the difference. It's not we're looking out 2 years and things look good. No, we're looking out 10 years and things look really good for the next 10 years. So it's a way to get slow and steady wins the race. And slow and steady is slow and steady now for possibly a decade. There's engineering construction companies that all got to build these things, right? And that's a lot of work that's going to get put into actually creating this infrastructure. There's the pipeline companies that need to hook up to all the power producers and the natural gas facilities to shift things off to actually produce this power. So there's a whole infrastructure segment that goes into the dividend space that actually looks really attractive, possibly next 5, 10 years. It's not particularly sexy, but the earnings are going to be there and the dividends are going to be there and the dividends are going to grow. And it's a great way to play this without having to go and I'm buying the next sexy thing that trades at 100 times earnings.
So about the dividend growth piece of it, so with the growth of a company, and it sounds like some of the companies, as you say, will grow steadily for quite a long time. Just kind of talk us through the calculation that you see for dividend growth and maybe a historical example, but what we're looking at for this.
Yeah, well, I think what I've always sort of advised the companies to do is just like find a payout ratio that works for you. And what I mean is payout ratio is just how much you pay out in terms of your dividends as a proportion of your earnings. And that should be a number that's sustainable, but you can also afford to grow and use CapEx and fund your CapEx, mostly internally, or have a good capital plan at least where you've got your money spent on first and foremost should always be your core operations and growing your operations, then your dividend, and then hopefully there's some money left over for buybacks or whatever else you're doing. So yeah, my general sort of thing, if you're growing earnings at 8%, find an appropriate payout ratio, and next year grow the dividend at 8%. And that's fantastic because if you just hold it and suddenly you're growing your dividend at 8% for the next 5 years, that's it's compound is more than a 40% growth in dividends, and that's fantastic. That's way more kind of growth than you're going to get buying a bond, buying GICs, buying anything like that. You may think, wow, I'm getting a 4% yield. In 5 years, your yield on your investment looks a heck of a lot better.
I want to come back to something you said almost off the top about the year it's been for Canada. We're talking about some investment for infrastructure here as well, but there's also a currency story actually that's really interesting.
Yeah, for the first time in a long time, Canadians have actually over the last number of months have actually felt their currency appreciate a little bit. So I mean, if you look at the markets this year, Canada is actually the markets are actually pretty soundly beating the U.S. market, currency adjusted. But you're getting paid in Canadian dollars. So you think about Canada being up sort of high single digits. The U.S. is still up, but currency adjusted, it's kind of flat. So this has been a really good year to have your money in good paying Canadian dividend stocks.
Okay, well, let's go to the banks, utilities, like
Sure.
telecom, come through some of the sectors. Actually, just broadly speaking, are you looking particularly at sectors to go not quite all in, or is it much more idiosyncratic?
I think it's given the volatility in the market this year. Usually, I have very strong views on different sectors, but it's sort of like, do you want to go fully defensive or fully offensive? The problem is it depends on the day. And there's been so much volatility in the market this year that I've really said, listen, I'm just going to focus on stock picking and not necessarily go crazy on making the big offense versus defense call because, as we saw, markets down 20, and suddenly you've got, 3 hours later, the market's up 10%. That's a year's return. If you weren't invested and you've gone all defensive, you miss a lot of that return, and that's a big part of your yearly return. So what I'm trying to do is just find stocks that I really like, not worry about too much about the sort of the macro fluctuations and what's going on with trade policy, because I'm having a trouble predicting it. I'm not sure the U.S. administration can predict what's going on a day-to-day basis. So just find companies that I think are really good values at the prices they're trading at. Have them in the fund, just sort of stock pick my way through and find companies that I think are going to be worth more in the next couple of years.
Connected to the utility story is energy. I mean, they're part and parcel. But energy is interesting because the price of oil, through some fairly rocky geopolitical moments, has actually been lower. There's a push-pull in sort of the overall scarcity story. Things aren't scarce is basically the story. Do you like that area? How do you look at that?
The answer is sort of it depends. So there's a couple things. The infrastructure side of it, I'm certainly okay with. Because I think there's going to be demand growing there. The actual sort of E&P side, so exploration and production, so the companies that actually are producing the oil, I'm getting a little bit less sort of interested there. And the reason is not necessarily demand. I think demand is holding in somewhere, growth is holding in somewhere below 1 million barrels. The problem is what we're seeing right now is it looks like OPEC wants their market share back. And
is willing to cut accordingly in terms of
they
the price.
have been very good in the last number of years trying to stabilize the market and taking millions of barrels off the market. The issue there is U.S. shale producers have stepped in and said, okay, if you're willing to cut, we're going to keep on producing. And I think at this point, OPEC, it looks like, has said, you know what, we're tired of ceding share to the U.S. They came out with another announcement of another 500,000 barrels they're bringing on, which brings their total capacity increased somewhere between 1.5 million and 2 million barrels. It hasn't actually hit the market. It'll hit the market sort of later this year because you can't say I'm turning it on and there's you got to actually.
Although there almost is in the Middle East, not quite.
It takes a couple months to ramp the capacity up. We're in peak driving season right now, which means demand's really strong. But as this supply comes back, it's an enormous amount of supply, and there's not enough demand to pull it back. So going into the fall here, I'm a little concerned that we probably have almost too much oil, and that's an area kind of been shifted the portfolio to, at least on the E&P side. The companies that actually produce it, shifting the fund to a little bit underweight. And I'd also say you've got no fight back from the U.S. administration on this, because a lot of the tariffs, what they're doing, it's inflationary, and a great way to offset that will lower oil prices. And so I don't think the Saudis are going to get any pushback from the Trump administration on having the oil price a little bit lower than usual.
It's one of the great offsets for the overall economy. If that's, it cushions a blow, certainly. Telecom has been an interesting space in Canada. I might ask you to broaden the discussion elsewhere, but they've essentially been a value trap for some time. Doesn't mean the dividends aren't there. Well, actually, in some cases they aren't, but not so now.
I think this comes into the case of a lot of the bad news is sort of out. So number one, this has been one of the very few sectors in Canada and probably the world that has taken not a lot of price over the last couple of years.
By that you mean they have not raised prices?
They have not raised prices. And you think about everything you've gone, you go to an industrial distributor, you go to a restaurant, you go to a grocery store, everything is way more expensive than it's been, except your cell phone. Because we had a fourth player come into the market, and it's a very competitive oligopoly. Hopefully that's at least stabilized a little bit now, and then we had the secondary hit of less people coming in. So if you're doing P times Q, if you're not raising price and you've got less people immigrating to the country, that's a very bad situation. We finally got the rumored Bell dividend cut that had been sort of on the table for the last couple of years. I think everyone thought you were paying out way too much money. Everyone was just waiting it. The company kind of didn't want to do it, and finally realized, listen, we got to do it. So the dividend's down 50%. You got a very complicated MLSE deal between Bell and Rogers that's now completed. Guess what? The Lakers just sold for $10 billion the other day, so MLSE is actually probably worth something. People
and lots of asset sales all over the place.
Yeah, and asset sales that can kind of fund that, and valuations that are very low. Listen, for people that are looking for telecom to be a big growth industry, not happening. Like ARPU, average revenue per user, started sort of flattish. Hopefully by the end of the year or next year, it starts coming up a little bit. You take a little bit of price, that's good. But there is something that goes, and stocks can work if there's less bad. The stocks are trading at very low multiples. There's probably a lot of the bad news is in, things are stabilizing in. The dividends are now sort of stable in there, and with cheap valuations, there's probably a little bit of room for things to move up. Don't expect it to become a growth industry, but the stocks, I would have told you over the last sort of year or two, it's a sector I kind of want to avoid. It's probably a sector I'm less negative on right now because a lot of the bad is in.
So that's great. We've spoken about utilities, telecom, energy. Let's go to the banks. Then I want to ask you a bit about your positioning.
Sure.
A lot of questions actually coming in on banks and also just kind of how you've adjusted and positioning yourself. So the banks themselves, for the last couple of years, the mortgage overhang has been the discussion. Then obviously the tariffs came on top of it. There are a few moving parts. There's also a deregulation story that I'd love you to comment on. But broadly speaking, how have banks been for you within the portfolio?
Banks have been good. And the sort of like the areas I was kind of focused on this year were idiosyncratic stories. So things where things went really wrong last year. So you had one particular bank in Canada that had awful anti-money laundering issues last year, but incredible Canadian franchise. And traded a huge discount that it never trades at. So it's in my top 10. So you can see like TD Bank. That's been I thought that was a really interesting idea for the year. It's worked out well. You got other banks maybe that had higher provisions last year. Hopefully provisions start coming down. I think that's one of the things that the market's kind of looking at, right? Because for the last couple of years, You've said, okay, maybe the mortgages are going to be tough because interest rates have gone up a lot. I mean, the wind got hit with tariffs. Everyone's been predicting a recession. So the banks have gone up, and for the last sort of year, 2 years, provisions have started going up. Now they are and that's slowed earnings growth to, they're still growing a little bit, but not much. But when your provisions are going from 25 bips up to, 50 or 60 basis points, that puts a real slowdown on your earnings. But you get to a case where you actually may have provisioned enough, or you may, and I think the market's kind of saying, wait a sec, what if the companies actually are not going to provision, that we've hit sort of peak provisions, and over the next couple of years, things kind of stabilize and start coming down, and the bank's earnings start growing a fair bit. And that's why you've gone from 9 times earnings to 11 or 11.5 times earnings multiple, because there's an idea that pre-provision earnings are still growing a little bit, not much, but a little bit. But if provisions start coming down and the economy actually is okay, then earnings growth could really get going in the next couple of years. And that's why I think you've seen banks start to perform a little better this year.
It's a really interesting area, as you pointed to, just with provisions for credit losses.
And then I guess there was regulation.
And regulation, yeah.
Yep.
So it might get less bad too? Is that a bit of a less bad situation?
I think we were talking about this, and it's sort of an area where it's really hard to deviate from the U.S. a lot. And we know one of the U.S. administration's big
three-legged
pushes,
stool.
is deregulate, deregulate. So it's going to be the last, as long as I've been around Fidelity, at least since the financial crisis, it's very much been capital ratios need to go up. So you need to hold more equity, and that's going to slow you. Hold more equity, you slow down earnings, you become more stable. But tier 1 capital ratios have gone, from high single digits up to 13. Most of the people are holding north of 13% right now. That probably stops being a headwind. And I think because Canada's not going to be able to say we're raising things while the rest of the world is actually dropping things, and especially your biggest counterparty where a lot of the Canadian banks operate down the U.S. is actually going to be, taking regulation out. So from a regulatory standpoint, it probably gets a little bit easier, even if it's not, we're dropping things, we're just holding it steady, but that's holding steady for the first time in a large number of years. The banks can actually generate capital without having to put more aside, and more can go to, productive, ROE enhancing, earnings enhancing activities.
And growing dividends?
And growing dividends.
Something else you've been doing since you've been at Fidelity, I think, is covering real estate.
Yeah.
And this is a sector that actually there's a new fund. This is an alternative. It's a real estate trust that you're managing. It's actually for accredited investors. So everyone just needs to ask the person that they contact at Fidelity about this and exactly what that will mean for them. But with that said, just reintroduce to us this fund a little bit, and also, you've been playing a role in this area of the market for a long time.
Yeah, so I've been looking. I used to be the real estate analyst at Fidelity a long time ago, and I've been looking at real estate for about 20 years. But this is actually a really exciting new fund, Fidelity Alternative Real Estate Trust. Fidelity's partnered up with Brookfield. So we, I think, as a firm, have kind of decided that we probably were underallocated to some private assets. And what a major asset class there that we didn't have a big asset allocation to was real estate. And we decided, what better partner could you possibly have in Canada? It's been around for decades and decades, has sort of more people on the ground than anybody knows, is the first call for most assets, than partnering up with Brookfield. So it's sort of, think of the fund as sort of a 70-30 split, 70% being private assets, and the Brookfield team is going to go out and look to buy those. And so far,
actual buildings.
Actual buildings. Yeah. So it's actual apartment buildings, it's actual logistics buildings. That's sort of where we've been partnering. And for 30%, which it takes care of some of kind of the liquidity in the fund, we'll be doing our research staff here and myself as portfolio manager doing sort of North American REITs. And
so it's liquid.
Yeah, so we have liquidity in the fund because you don't want to match sort of an illiquid asset versus a liquid fund. So I think it's sort of a good setup. I think the thing that's really interesting about this is one of the asset classes that's not near all-time highs.
Okay, so why is that a big deal? Because actually, there's a question coming in about talking about, maybe real estate seems a little bit stagnant.
Yep.
But you like that
because it speaks to. I like stagnant. I like value, but I like stagnant, but potentially getting better. Okay. So the idea is, you think about, I go back and give just a brief overview. 2021, really great year for real estate. Why? Rates are pinned at zero. Central banks aren't raising yet, and demand is really good. So you've got cap rates that are sort of on the floor. People are paying huge numbers to get any yield. You go through the next couple of years, what happens? The market starts raising rates, or the central banks start raising rates in the market on the back end. And you go from 0 to 5. That puts a lot of pressure on interest rate sensitive companies, and real estate are right at the top of them because they're stable, they carry a lot, but they carry a fair bit of leverage. On top of that, in 2021, because rates were pinned at 0, you had a lot of very cheap financing. So people went out and said, can I build the next apartment building? Can I build the next logistic building? So you had this big wave of supply come on that's sort of just petering out now. And now you got a case where, okay, values have readjusted to sort of, the 5% interest, 4 or 5% interest rates, at least down in the States. And one, your costs have gone up for everything. So it's really expensive to build stuff right now. And two, getting financing is really hard because rates are up now and people want much higher interest rates. So what you've seen is real estate, there's a fair bit of supply that's come online. Markets adjusted to the higher, values adjusted downwards to higher interest rates, but that supply is now starting to peter out. And over the next couple of years, you're going to see supply come down. Demand, if you talk to the guys at Brookfield, is that this is one of the first cycles they've ever seen where demand hasn't been a problem. Most of the things they're looking at are 95% plus occupied. So demand's actually really good. So you've got a case of where values are actually pretty reasonable. Supply over the next year or two is going to continue to fall, and demand is actually fairly strong. Supply and demand fundamentals improve, which is a key to real estate, and values are actually not near all-time highs like the rest of the market. Interesting place to think about putting some money that maybe you can say, okay, it's a little more diversified, private real estate, less volatile than the overall market, and there's really good value there. So go and put things away for the next 5 or 10 years, and I think you do really well. And this is sort of a core plus type fund. So think about looking at 8-10%, hopefully you can get more, but type returns, but more stable than the market, but where values are pretty reasonable.
Fascinating. So interesting to hear about this particular fund, your role in it, and how it's how it's available to investors. There's a final question here. It has to do with real estate too. So would ultimately rising mortgage defaults hurt the banks? I mean, this has been the question for some time. What's your thought at this point?
So the answer is yes. If they were actually seeing that. The interesting thing is a lot of we were, I think, worried about rates sort of rolling over, and it was 2024. In 2020, in this year has been a huge mortgage roll. Things now, rates in Canada have been cut a fair bit and come back down. That's helped people out. So they're no longer, rates have come down enough that what the banks will tell you is, yes, it's hurt people, but people are still paying their mortgages. Maybe they've cut back a little bit somewhere else, but there is no giant wave of defaults that people were projecting. It just hasn't happened. A combination of people cutting back, job market's been pretty good. Generally, everyone still is still employed, and people may have cut back other places, so mortgages are still being paid. So what the banks will tell you, we've taken provisions, and the provisions will most be in areas where it's non-secure, not necessarily the mortgages, but where you see it first is like the credit cards and non-secured loans, and those have, the defaults have gone up a little bit, but they've been well provisioned for, and the catastrophe that people were potentially projecting and why the banks were down at 8-9 times earnings just hasn't materialized. And they're saying we're not seeing it.
So that's great. And you've answered actually a ton of the questions that are here. Just a couple of seconds here to just kind of wrap up the case that you began with. It's been an extremely, I mean, some people need some rest after this first half year watching these markets, but just kind of the steady hand that dividends provide.
Yeah, I mean, I'm a huge fan of good companies, reasonable prices, maintain and grow dividends over time, combination of good dividend, price appreciation, bought at a reasonable price, put it away, keep the volatility a little bit lower than what you'd see in some of the indexes. And I sleep at night, the investor sleeps at night, the investment advisor sleeps at night. You look at it in 5 or 10 years, you've compounded a heck of a lot more than if you were in going and, oh geez, this looks great, I'm in. This looks, oh no, it's bad, I'm out. And you can destroy a lot of value through trading needlessly and getting very excited and getting very depressed. Keep the idea of a steady hand, good income, reasonable valuations, and things that just compound over time, and you end up doing really well, and you still sleep at night.
Don Newman, great to have you join us. Thank you for your time here today.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.